Have you ever opened your charts and felt completely stuck? You've done your analysis, but you were unsure whether you have to buy, sell, or stay out of the market completely. It feels like your mind is paralyzed and refusing to think clearly. In a situation like this, you might find yourself taking some random trades for the sake of taking trades and later on questioning yourself, why the heck did you take that trade? This is exactly what we call analysis paralysis, and in this video we will discuss why it happens and how you can avoid it. Stick around, because at the end of the video, in just 3 minutes, I will break down to you my mechanical edge over the markets that removes all the guesswork from trading. Hey folks, welcome back to OP Investing. This is Islam with you. Here we help anyone who have extra 15 minutes a day to scale their trading to 6 or even 7 figures in just 30 days without any complex analysis or being stuck to your charts. So make sure to subscribe to this channel not to lose it. Let me share with you the story of the Roy Baumeister, the social psychologist. In early 2000, Dr. Roy made a survey among few thousand people and discovered that people make about 50,000 decisions every single day. But there was something interesting. The quality of the decisions that we make drops significantly as the day progresses. Intrigued with the results, he conducted the studies with thousands and thousands of people and found out that after only making 10 to 15 decisions, the quality of our decision making declines significantly. He called this phenomena the decision-making fatigue, when our mind gets depleted by making the numerous numbers of decisions over the day, so it struggles to process the information effectively, leading to impaired judgment. People in this state of mind take some impulsive decisions or just avoid making decisions altogether, or stick to the default mode. His research also showed that decision fatigue leads to physical symptoms like irritability, frustrations, and mental exhaustions. Sound familiar? This is exactly what happens to traders. In this fast-paced world, we take hundreds or even thousands of decisions every single hour. This drains our mental energy. So when it comes to trading, our mental energy, our mental capacity is already empty. When you look at the charts, your brain is already in a decision-making fatigue state. That is the exact reason why you take those impulsive trades, why you are not able to control yourself and end up just questioning the trades you took later on. But that's not the end of the world, guys. As I promised, I've got a solution for you. To avoid the analysis paralysis, all you have to do is just to remove the decision-making process altogether from your trading plan. How is that even possible, you might ask yourself? So just keep watching and I will explain it to you in a second. To avoid getting caught up in a decision-making fatigue state, all you have to do is just to remove the decision-making from your trading and follow the mechanical strategies that doesn't require any thought process or decision-making from you while you trade. First of all, you have to shift from the predictive state of mind where you try to anticipate what is going to happen next in the markets to the reactive state of mind. Those complex thought processes that you are doing is not necessary. Instead of that, you need to be calm and let the market tell you where it wants to go. Be reactive to the price action. Wait for your setups to get formed and then take your trades. Many people think that they are trading the mechanical strategy when in reality they are not. I actually have a formula how does the real mechanical strategy looks like, and I'm going to explain it to you with an example with my own strategy. For the strategy to be mechanical, you have to think in terms of if and then. So if the price do A, I will do then B. If the price do B, then I will do the C. We're not trying to predict the market. We're simply reacting to the price action. And the best way to trade the mechanical edge over the markets is by trading the recognizable patterns. At the first glance, markets might seem to you a completely random place. But if you study it deeply, you will see that there are some patterns that repeat themselves over and over again. And these patterns fall into the 3 main categories: the breakout patterns, the reversal patterns, and the manipulation patterns. Here I want to show you how does the mechanical breakout pattern works in an example from my own strategy. Okay folks, here I want to show you how does the fully mechanical strategy works with the example from my own personal strategy, which is fully 100% mechanical. And I'll explain it to you why it is so mechanical. Basically, this is a day trading strategy. All you have to do is just to open any pair on the 15-minute time frame. So we only use one time frame. Then what we have to do is just to define the first 4 hours of the Tokyo session. Do you see this vertical gray stripe? These gray stripes represents the first 4 hours of the Tokyo session. And for that, I use this indicator, which is called sessions. And the settings you can see over here. So basically, when this range formed out, all we have to do is just to mark up the high and the low of the price action during those 4 hours. And we will be trading the breakout from this range, like either to the upside or to the downside. This is so mechanical. Why? Because this is exactly the same range for you and me, because it is defined by the time, which is exactly the same for you and me. So basically, all we have to do is just to wait for the a good real breakout out of our range, as you can see over here. Over here, we do have some sort of the breakout, but we don't take that into consideration because that's only one candle breaking out and the second candle is just closing again inside of the range. But over here, you can see the strong breakout to the downside and one more candle confirming the breakout actually to the downside. And in this case, our entry criteria are pretty simple. All we have to do is just to draw our fib levels from the very top to the low to the very bottom of the breakout and place our trade at the 60, at the golden zone. This is called the golden zone, from 80 to 60%. And basically, I like to trade 60 or 70%. When the breakout size is pretty decent, we can place our trade at the 60%, the stop loss above 80%, and just aim for 5R. Most of the times our targets are going to be the same, exactly the same, like 5R, because we are trading relatively to the price action which is happening right now, because we cannot say that we will be aiming only for 15 pips or 20 pips or 30 pips. We cannot judge based on the pips, because each day is going to have its own relative range, liquidity, the price action, whatever you're going to call it. Basically, we can go to the next day over here. So basically these lines over here, you can see this green line shows that this was the opening of the London session, and this pink line represents the New York session. So basically, sometimes we are going to have our entry during the London Open. Sometimes we are going to have our entries during the New York session. So basically, this strategy works at both major sessions, at the London and New York session, whatever works for you. So the next day is the same. Over here we've got our first 4 hours formed. All we have to do is just to draw our high and low, and again wait for the breakout either to the upside or to the downside. And again, as you can see over here, we've got another breakout to the downside. All we have to do is just to draw our fib levels from the very high to the very low, and just place our trade at the 60 or 70%. Let's place it on the 60% again. The 80% is going to be our stop loss, and we will be aiming for 5R again. So this is pretty much how it works, guys. This is called OP method number 1. And you might be thinking okay, not every day this might be working. Of course, this is not a holy grail. This is not going to work every single day. For example, over here, we've got the breakout to the upside, but price never came back to retest our range. And sometimes we might have some choppy price action where we're not going to have sometimes we might have the losing trades as well. For example, the price broke to the downside, but on the retest, it took us out. But over here, the extra confluences come. The markets does not only work with a breakout. Actually, there are 3 models. The first is the breakout. The second one is the reversal. And the third one is a manipulation trading, guys. This is why, if you combine all of those 3 methods, you will be able to cover pretty much the 95% of all the price action that happens during a day. If you like my approach, guys, just check out this video where I break down my whole approach to the markets.